Let's start with the globally coordinated effort. I think there's been an effort from central banks that has been reasonably globally coordinated, but we need more effort than that. We need fiscal policy. We haven't contained. I think we can stop using the word containment in the U.S. It is uncontained. And now the oil market is really kicking the horse while it's down. Although I do expect this oil thing to slowly figure itself out, this is a situation where no matter how helpful it is to the consumer that we have lower oil prices, what it's doing is it's exposing vulnerabilities in the credit market that could send the market further and further into tailspin, and that's what we're worried about.
So, Josh, I'll lead into you with a tweet from Lloyd Blankfein moments ago who says, quote, fear can take the market lower, but expect quick recovery when health threat recedes, especially in U.S. underlying economy strong, banks well-capped, system not too leveraged. Unlike '08, will avoid systemic damage that could take years to work through, obviously not ignoring the tragic human toll. That's from the former CEO of Goldman Sachs, Lloyd Blankfein. So I lead into you. Are markets overdoing it?
So I don't have any special expertise beyond what Mr. Blankfein said. I hope he ends up being right. I think it's reasonable to assume that he will be. If you look at the February jobs report, which was a non-event, obviously, in the context of this, but we really were rocking and rolling in every category other than manufacturing. Like, most of the economy was doing incredibly well. Ironically, the bright spot was hospitality, travel and leisure, which, of course, will no longer be the case when we see the March number. But I think that point that things had been on a very favorable trajectory, we now have at least one quarter, maybe 2 quarters of quite frankly, very, very negative activity with less travel, less meetings, people not being hired. We are all now expecting that. But on the other side, do things get back to that original trajectory? Well, the Fed is easing. We've not had industry-wide blowups anywhere, not even in energy yet. It is possible that you'll see some people default on junk bonds. I don't know why that would be unreasonable given this environment. But if what Lloyd is saying is true and ends up being right, then yes, Scott, to answer your question, people are to some extent overreacting. But you get it. There's 2 reasons why. Number one is the speed. Joe mentioned velocity. This is 18 days from an all-time record high to a 52-week low, down 20%, almost 20%. That is remarkable. The other thing is today, we've only had 32 days since 1950 where the S&P has fallen more than 5%. This looks like it's going to be the 33rd, depending on where we close. But so it doesn't happen. It has happened before. It's not unprecedented. It doesn't happen all the time. So there's a reason for people overreacting. It is scary. And then you throw in the health issues. We're not just worried about a trade war like we were in 2018 when we dropped 20%. People are literally worrying about their survival. They're going to bring home germs to their family. Those things are being entangled
That's right.
with price action.